At its height, Venezuela's oil giant PDVSA pumped more than 3 million barrels a day, fueling an entire nation and shaping global energy politics. But after years of decay, international sanctions, and technical collapse, output has fallen below 800,000 barrels daily. Now, amid shifting power in Washington, and with Donald Trump signaling a return to pressure, the fate of Venezuela's oil and infrastructure stands at a crossroads. What real leverage does the next U.S. policy shift hold? And how did a country with the world's largest oil reserves unravel to this point? Venezuela's oil sector, for decades, operated on a scale that few countries could rival. The nation holds 303 billion barrels of proven crude reserves, by far the world's largest reserves, surpassing even Saudi Arabia. At its peak in the year 2000, Petróleos de Venezuela S.A., spelled PDVSA, managed a production engine reaching 3.1 million barrels per day. This output powered not just the domestic economy, but also supplied global markets, with oil accounting for 95% of Venezuela's export revenue and funding half of the government's budget in the early 2010 ES. The infrastructure supporting this system was immense. The Orinoco Belt, stretching across central Venezuela, became the world's largest extra-heavy crude development, feeding a network of pipelines and export terminals. The Jose terminal alone handled hundreds of thousands of barrels daily, while the Paraguana refining center, once the largest refining complex on the planet, boasted a nameplate capacity of 940,000 barrels per day. Across the country, more than 20 export terminals and a web of pipelines connected inland fields to Caribbean ports, giving PDVSA unmatched reach in the Western Hemisphere. The Orinoco Belt anchored much of that scale. On average, between 1998 and 2013, national output held steady around 2.5 million barrels per day. Refining capacity reached 1.3 million barrels per day, allowing Venezuela to process not just its own heavy crude, but substantial volumes for export. Tankers loaded at Jose, Amuay, and Bajo Grande carried shipments to the United States, Europe, and Asia, making Venezuela a top supplier to United States Gulf Coast refineries that specialized in handling heavy oil blends. Refining capacity underpinned export patterns. The scale of the operation extended to human capital. PDVSA, at its height, employed more than 100,000 workers, including tens of thousands of engineers and technicians. The company's technical expertise drew on partnerships with major international oil companies before nationalizations in the 2000s. Its downstream subsidiary, CITGO, operated 3 refineries and nearly 5,000 service stations across the United States, with a combined refining capacity of over 800,000 barrels per day. Human capital sustained complex operations. Every element, from the Orinoco's vast reserves to the sprawling Paraguana complex, reflected a system built for magnitude. Venezuela's oil sector was designed for high-volume, continuous operation, with infrastructure sized to sustain production and exports at global scale. These figures, 303 billion barrels in reserves, 3.1 million barrels per day at peak, 1.3 million barrels refining capacity 940,000 barrels per day at Paraguana, and a long-term production average of 2.5 million barrels per day form the analytical baseline. They anchor any assessment of what has since been lost and what remains at stake as Venezuela's oil future is debated. Inside Venezuela's oil plants and refineries, the first signs of decline appeared long before international sanctions tightened around the industry. By the early 2010s, maintenance routines had grown sporadic. Spare parts for critical equipment, including compressors, pumps, and control systems, became scarce as procurement budgets shrank and international suppliers withdrew. Outages at the Amue and Cardin refineries, once the backbone of the Paraguana complex, began to multiply. In 2012, an explosion at Amue killed more than 40 people and forced a shutdown that lasted weeks. The incident underscored the risks of deferred repairs and aging infrastructure. Engineers and technicians, many with decades of experience, found themselves improvising repairs with salvaged components. The supply chain for specialized parts, previously sourced from North America and Europe, broke down as foreign vendors demanded cash up front or refused to ship altogether. According to a Reuters investigation, refinery utilization plummeted by 70% between 2010 and 2020, a drop mirrored in the number of functioning units at the country's largest complexes. By 2019, Paraguana's vast towers and tanks operated at less than a third of their designed capacity, often idled by electrical failures or fires traced to neglected safety systems. The human dimension of this decline was equally stark. Between 2017 and 2022, more than 40,000 skilled workers left PDVSA, seeking stability abroad, or shifting to informal work within Venezuela. This exodus included process engineers, control room operators, and pipeline specialists, roles essential to keeping the system running safely. LinkedIn data and field interviews confirmed that by 2021, the technical workforce had shrunk by 80% from its peak. Remaining staff faced mounting workloads and chronic shortages of even basic supplies, from lubricants to protective gear. The collapse of the spare parts supply chain created a cycle of outages and improvisation. At Cardin, refinery logs reviewed by the Financial Times documented repeated shutdowns caused by pump failures and jury-rigged wiring. In several cases, makeshift repairs held for days or weeks before giving way, resulting in further downtime and lost output. The situation at the Jose terminal, the main export hub for Orinoco crude, was similar. Tankers queued offshore as loading arms malfunctioned and storage tanks reached capacity due to bottlenecks upstream. Even before sanctions isolated the sector, these physical and human failures had eroded Venezuela's oil infrastructure from within. The system's scale, once its strength, became a source of fragility. Vast networks of pipes, plants, and ports required constant attention, but were left to deteriorate as resources dwindled and expertise vanished. In August 2017, the United States government issued Executive Order 13808, setting the first major statutory block on Venezuela's access to United States financial markets. The order, published in the Federal Register, prohibited dealings in new debt and equity issued by the government of Venezuela and its state oil company, PDVSA. This action drew its legal authority from the International Emergency Economic Powers Act, spelled IEEPA, a statute enacted in 1977 that grants the president broad powers to regulate commerce after declaring a national emergency that threatens United States interests. The language of Executive Order 13808 specifically barred United States persons from purchasing Venezuelan government bonds or extending new credit, effectively freezing the Maduro administration's ability to refinance debt or raise funds through Wall Street. A year later, in November 2018, Executive Order 13850 expanded these restrictions. This order authorized the Treasury Department to target individuals and entities operating in Venezuela's gold and oil sectors, including PDVSA. Under Executive Order 13850, the United States could block all property and interests in property of designated persons and prohibit United States persons from engaging in almost any transaction with them. The Federal Register entry for Executive Order 13850 detailed the rationale, citing ongoing corruption, human rights abuses, and the erosion of democratic processes. By January 2019, the Treasury's Office of Foreign Assets Control, spelled OFAC, used Executive Order 13850 to formally designate PDVSA, freezing its United States assets and banning oil transactions with American companies. Both executive orders reference the International Emergency Economic Powers Act as their statutory backbone, a legal framework first enacted in 1977 and invoked repeatedly for sanctions regimes worldwide. The orders themselves are concise, but have sweeping effect. Executive Order 13808, dated August 24th, 2017. And Executive Order 13850, issued November 1st, 2018, together form the legal foundation for all subsequent United States restrictions on Venezuelan oil, finance, and infrastructure. Their publication in the Federal Register, Volume 82, Number 165, for Executive Order 13808, and Volume 83, Number 214, for Executive Order 13850, makes their full text and scope accessible to the public, codifying the rules that would govern all United States dealings with Venezuela's government and oil sector for years to follow. Drafted by legal and policy teams within the National Security Council and the Treasury Department, these orders established the boundaries within which United States companies, banks, and investors could operate. Any violation risked severe penalties under federal law. The statutory foundation, outlined in these executive orders, did not just target individuals. It defined the operational environment for PDVSA's global transactions, foreign partnerships, and access to capital markets. From this point forward, every attempt by Venezuela to finance infrastructure, repair refineries, or maintain export terminals would be measured against the prohibitions and licensing requirements set out in these federal directives. On January 28, 2019, the U.S. Treasury Office of Foreign Assets Control formally designated PDVSA as a sanctioned entity. Overnight, Venezuela's state oil company lost access to its U.S. assets and was cut off from transactions with American firms. The Treasury's press release described the action as a direct response to ongoing corruption and the erosion of democratic institutions. The effect was immediate. Tankers bound for U.S. ports were forced to divert, and payments for Venezuelan crude froze in escrow accounts beyond the government's reach. This designation did not operate in isolation. Throughout 2019, the U.S. Treasury Office issued a series of advisories warning non-U.S. companies and shipping firms that secondary sanctions could apply if they continued to do business with PDVSA. By February 2020, these threats expanded to include insurers and financial intermediaries. Lloyd's of London and other major maritime insurers began to withdraw coverage for tankers carrying Venezuelan crude, making transoceanic shipments far riskier and more expensive. Trading houses in Europe and Asia, once regular buyers, paused or abandoned contracts rather than risk losing access to U.S. markets. Export data from OPEC and independent trackers reflected the fallout. In early 2019, Venezuela was exporting nearly 2 million barrels per day. By the end of that year, volumes had collapsed to under 400,000 barrels per day, a drop of 80% in less than 12 months. The Jose terminal, once a hub of activity, saw tankers idled offshore for weeks, unable to load or unload as payment systems seized up. Refineries in the Paraguana complex, already strained by years of neglect, now faced shortages of imported diluents and replacement parts that had once arrived via established U.S. suppliers. The impact extended beyond oil. With PDVSA's designation, foreign investment in infrastructure projects evaporated. Maintenance on pipelines, ports, and refineries became a matter of improvisation or abandonment. By 2020, the U.S. Treasury issued further warnings, signaling that even indirect support for PDVSA's operations, such as shipping, insurance, or technical services, could trigger enforcement actions. The threat of secondary sanctions created a chilling effect that reached far beyond American borders, isolating Venezuela's oil sector from the global financial system. Within Venezuela, the consequences were stark. Export revenues, already in decline, dried up almost entirely. The government lost its main source of hard currency, while PDVSA struggled to pay suppliers and retain skilled workers. The collapse of trade not only crippled oil exports, but also accelerated the decay of the infrastructure that once powered one of the world's largest oil economies. As the designation and its ripple effects took hold, Venezuela's oil sector entered a period of contraction from which it has yet to recover, setting the stage for the challenges that define its current condition. Venezuela's oil sector now operates at a fraction of its former scale. According to the OPEC monthly oil market report, from November 2025, national crude output averages 800,000 barrels per day. This figure, while higher than the 2020 nadir, still represents less than one-third of the country's pre-sanctions production. Of this total, 250,000 barrels per day are processed through domestic refineries, far below the 1.3 million barrels per day capacity the system was designed to handle. The remaining output is primarily exported, with official data and independent tracking pointing to 700,000 barrels per day leaving Venezuelan ports, most of it heading to buyers in China, and India at discounted rates. Inside the plants, production crews contend with chronic shortages and aging equipment. The Orinoco Belt, which once supplied a steady stream of extra heavy crude, now relies on a complex blend of imported and locally sourced diluents to keep operations running. Without these additives, the thick crude cannot be moved or exported. In June 2024, the Orinoco region produced around 535,000 barrels per day, but nearly one-fifth of that volume depended on imported naphtha and condensate. The supply chain for these critical inputs has shifted repeatedly, moving from Iranian condensate to U.S. naphtha under temporary licenses, and most recently to Russian supplies after American authorizations expired in May 2025. At the Jose terminal, Venezuela's main export hub, storage tanks often hover at half their design capacity. Tanker traffic reflects the new reality: fewer vessels, longer wait times, and a heavy reliance on non-Western buyers. Refinery operations at the Paraguana complex remain limited, with utilization stuck at roughly 30%. The plants process less than a quarter of their intended throughput, and outages are frequent. Engineers report that the system can sustain current levels only if diluent imports remain steady. Any disruption, whether from sanctions enforcement or logistical delays, would quickly force production cuts upstream. Chevron's joint ventures, operating under U.S. Treasury waivers, account for about a quarter of Venezuela's total output. These partnerships have stabilized some fields, but cannot compensate for broader technical decay. The workforce now numbers around 50,000, a sharp drop from historical levels, and many crews work with minimal resources. The latest data from the Energy Information Administration confirms that refinery runs remain stuck at 250,000 barrels per day, underscoring the gap between installed capacity and operational reality. Production, refining, and export numbers are 800,000, 250,000, and 700,000 barrels per day, respectively. These figures define the boundaries of Venezuela's oil sector today, and they set the stage for the infrastructure strain and policy leverage that shape every decision in the industry. Every barrel of Venezuelan crude now threads its way through a maze of mechanical limits, with the Jose terminal at the center. Built for 700,000 barrels per day, Jose runs far below that mark. Storage tanks often sit half full, not because production is booming, but because upstream bottlenecks and a chronic shortage of diluent keep the flow slow. Tankers wait offshore, sometimes for days, as blending units stall or pump systems break down, waiting for parts that may not arrive. Orinoco Belt crude is too thick to move without imported diluents, naphtha, or condensate that lighten the oil for shipment. By mid-2025, Venezuela needs between 50,000 and 100,000 barrels of these additives daily just to keep operations steady. When United States naphtha licenses expired in May 2025, Russian cargoes filled most of the gap, according to IEA and Reuters. But this fix is fragile. Any disruption in Russian supply, sanctions, shipping delays, or payment issues can choke the system. The margin for error is slim. If diluent imports fall short for more than 6 weeks, Orinoco output drops, and the shortfall echoes down to Jose and every terminal beyond. Paraguana, once the world's largest refining complex, now operates at just 30% of its designed capacity. The plants process less than a quarter of the crude they once did. Most units are idle or only run when engineers can scrape together enough feedstock and spare parts. The technical staff, now a fraction of its former size, must constantly decide which units to keep alive, shuffling resources between Amoué and Cardin to handle the latest breakdown. Foreign dependency runs through the entire system. 70% of replacement parts and specialized equipment once came from the United States and its allies. Now, PDVSA relies on irregular shipments from Russia, China, or Iran, routed through intermediaries. Supplies are unpredictable, and the quality of parts varies. On paper, storage at terminals like Jose could buffer weeks of exports, but in reality, maintenance issues and compartmentalization mean tanks are rarely filled to optimal levels. Floating storage, meaning crude held on anchored tankers, serves as a temporary fix, but only postpones the inevitable impact of upstream shortages. The system's reach is now defined by its weakest links. Every step, diluent imports, blending, storage, and tanker scheduling runs close to the edge. For engineers at Jose and Paraguana, the challenge is daily and mechanical, not theoretical. On a humid night in August 2024, Donald Trump stood before a packed crowd in Miami. He declared that sanctions would stay until Maduro was gone. The statement appears in rally transcripts, and it circulated widely on social media, and it left little room for ambiguity. For months, the campaign returned to that line, tying Venezuela's future to the fate of its current leadership and linking United States policy directly to regime change. In October 2024, on his official social media account, Trump posted that America comes first and that no Venezuelan oil would flood the American market. Those words drew a clear line between domestic energy priorities and any prospect of renewed oil imports from Caracas, and they signaled to allies and adversaries that the campaign's stance on Venezuela was not up for negotiation. These statements did not appear in isolation. They echoed the language and posture of Trump's first term, when executive orders and United States Treasury designations set boundaries for United States engagement with Venezuela's oil sector. The August and October 2024 remarks, delivered in public and preserved in digital records, provided a window into the campaign's priorities before any policy was drafted in the West Wing. The continuity in tone and content, demanding the removal of Nicolas Maduro, promising to maintain pressure, and rejecting Venezuelan crude as a matter of economic and national security, offered a preview of the approach likely to follow if Trump returned to office. Grounded in campaign transcripts and official posts, these statements functioned as both political signal and policy warning, framing the debate over Venezuela's oil and infrastructure as a test of resolve. On February 26, 2025, Donald Trump published a statement on his Truth Social account that set a new direction for U.S. policy toward Venezuela. The post said, "We are hereby reversing the concessions that crooked Joe Biden gave to Nicolas Maduro on the oil transaction agreement dated November 26, 2022. With these words, Trump announced the immediate revocation of licenses that had allowed U.S. and European firms to purchase Venezuelan crude under strict conditions. The language was direct, naming the date and the target, and left no ambiguity about the administration's intent to dismantle the previous framework. The statement came just weeks after Trump's inauguration, and it was amplified across news outlets and diplomatic channels. U.S. oil companies operating under Treasury licenses received formal notifications that all authorizations, except for Chevron's limited waiver, were rescinded. The move effectively ended the short-lived window that had permitted non-Chevron buyers to import Venezuelan oil, halting shipments that had reached an average of 216,000 barrels per day to the United States in late 2024. Industry analysts noted that the February 26, 2025 post did more than signal a return to maximum pressure. It reintroduced legal risk for shippers, insurers, and traders who had begun to test the boundaries of the earlier sanctions regime. The new messaging also included a migration element. Administration officials paired the oil license reversal with public remarks tying border security and deportations to pressure on the Maduro government, referencing the flow of Venezuelan migrants through the Darien Gap and into the United States. The policy update was not limited to the oil sector. It was part of a broader toolkit that included legal leverage over migration and financial flows. By specifying the revocation date and the Biden-era agreement, Trump's post-inauguration declaration delivered an actionable policy shift. The revocation was not just a rhetorical gesture. It triggered a wave of compliance reviews, forced cargo diversions, and prompted European refiners to seek alternate suppliers. The administration's intent was clear. The era of conditional engagement with Venezuela's oil sector was over, and every future transaction would be measured against a new standard of enforcement. In a Delaware courtroom, the future of See It Go, Venezuela's most valuable foreign asset, has played out not on oil fields or refinery floors, but in legal filings and auction notices. At the center of the dispute sits PDV Holding, the Delaware incorporated parent of See It Go Holding, which in turn owns See It Go Petroleum Corporation. This corporate chain, built decades ago to manage tax and regulatory obligations in the United States, became the focal point for bondholders and creditors after PDVSA, Venezuela's state oil company, defaulted on billions in debt. Legal focus: in 2016 and 2017, PDVSA pledged 50.1% of PDV Holdings shares as collateral for a $3 billion bond issuance. When payments stopped, creditors moved to enforce their claims. By 2018, lawsuits in federal courts in New York and Delaware named PDVSA, PDV Holding, and related entities seeking attachment of See It Go shares to satisfy arbitration awards and defaulted bonds. Crystalex, a Canadian mining firm, and ConocoPhillips, an American oil company, led the charge, arguing that PDVSA's U.S. assets could be seized to settle debts owed by the Venezuelan state. Collateral and debt. The U.S. Treasury's Office of Foreign Assets Control, known as OFAC, stepped in under Executive Order 13,850 to freeze any transfer of See It Go assets to the Maduro government. General License 39, issued in 2020 and amended several times, authorized only the U.S. recognized ad hoc board appointed by opposition leader Juan Guaido to operate See It Go and PDV Holding. Dividend payments were blocked and held in escrow, out of reach of PDVSA's Caracas headquarters. For years, nearly $3 billion in Citgo earnings accumulated in U.S. custodial accounts, untouchable by either side without court or Treasury authorization. Sanctions and control. In late 2022, the Delaware Chancery Court approved a process to auction shares of PDV Holding. The court's written opinion stated that PDVSA's ownership, while recognized in corporate filings, did not shield the shares from creditor claims. The auction path was clear. Qualified bidders could submit offers for the holding company, with proceeds distributed to satisfy outstanding judgments. By 2024, the first round of bids was underway, supervised by the court and subject to OFAC licensing. The process was structured to prevent any transfer of control to sanctioned parties or entities acting on behalf of the Maduro government. Auction mechanics. Throughout this period, Citgo continued to operate 3 U.S. refineries and nearly 5,000 service stations under the oversight of the Ad Hoc Board. Annual reports filed with the Securities and Exchange Commission confirmed the arrangement. Operational decisions made in Houston, legal ownership traced to Delaware, and all major transactions routed through blocked accounts. The system functioned as a legal choke point, paper claims and court orders, not pipelines or tankers, determined who could exercise real control over Venezuela's most strategic overseas asset. Operational continuity. The Delaware docket, running to thousands of pages, documents each step. Share pledges, creditor motions, auction notices, and OFAC compliance letters. General License 39's language is explicit. No dividend or sale proceeds may be debited from blocked accounts without Treasury authorization. As of 2025, the auction of PDV Holding shares is set to conclude, with the winning bidder taking operational control of Citgo and the proceeds directed to satisfy creditor judgments. For Venezuela, the contest over Citgo has unfolded not through direct confrontation, but through the slow, methodical machinery of U.S. courts and sanctions law. Process and precedent. The outcome underscores how, in the modern oil economy, legal structures and financial instruments can be as decisive as physical infrastructure in shaping the fate of a nation's most valuable assets. Control through law. At the heart of Venezuela's oil logistics lies a problem that is both technical and strategic. The Orinoco Belt's extra-heavy crude cannot flow to export terminals without blending with lighter hydrocarbons, diluents such as naphtha or condensate. Each day, between 50,000 and 100,000 barrels of these additives are needed just to keep the pipelines moving. The system operates with a 6-week buffer, and if diluent imports are disrupted for more than 40 days, production at the Orinoco fields must be cut. The impact then ripples outward to the Jose terminal and to every tanker scheduled to load. This buffer is not theoretical. Shipping records and tanker tracking analytics show that since mid-2025, Russian naphtha has replaced nearly all United States volumes after United States licenses expired. Monthly arrivals from Russian ports, often routed through intermediary stops and flagged under third-country registries, now supply the majority of Venezuela's diluent needs. Spanish shipments continue, but at a scale too small to serve as a true alternative. The result is a supply chain that is fragile and exposed, reliant on a handful of suppliers, long shipping routes, and a maritime network where every voyage is a test of enforcement and risk. Maritime insurers play a decisive role. After the United States Treasury Office of Foreign Assets Control expanded secondary sanctions in 2019 and renewed pressure in 2025, major insurers such as LA Lloyd's of London began to withdraw coverage for vessels transporting Venezuelan crude or diluents. Without protection from the international group of P&I clubs, tankers risk detention, fines, or outright seizure. The cost of insurance for these voyages has soared, and many ship owners refuse to charter vessels for sanctioned cargoes. As a result, a growing share of the fleet now operates dark, disabling transponders or spoofing locations to avoid detection. These dark tanker networks have become the backbone of Venezuela's export and import system, but their capacity is limited and their reliability uncertain. The 6-week buffer is more than a number. It is a hard limit defined by storage capacity at the Hosey terminal and by the pace of incoming shipments. If a single Russian cargo is delayed, or if insurers clamp down on a cluster of vessels, the entire chain can seize up. Floating storage, once a backup, is now a necessity, with tankers idling offshore as makeshift warehouses. Floating storage is expensive and vulnerable to weather, piracy, and enforcement actions. Every week, PDVSA engineers and shipping coordinators must balance the inflow of diluent against the risk of running dry, knowing that a missed shipment can force a reduction in upstream output within days. Spare capacity in the system is virtually non-existent. Unlike other oil exporters, Venezuela cannot ramp up production to meet sudden demand or price spikes. The technical bottleneck is absolute, because without enough diluent, heavy crude stays in the ground. This constraint gives extraordinary leverage to those who control shipping lanes, insurance policies, and access to blending feedstocks. For United States policymakers, the ability to pressure insurers or sanction individual tankers offers a way to disrupt Venezuela's oil flow without ever touching a wellhead. For PDVSA, every successful delivery is a narrow escape, a brief extension of operations before the next logistical hurdle. The entire export chain, from Orinoco to open sea, is defined by a race against time and the constant threat of interruption. Global energy flows through pipelines, not promises, and every policy shift redraws supply and power. Today, Venezuela's crumbling infrastructure sits at the intersection of U.S. strategy and world oil demand. Washington's choices ripple far beyond Caracas, shaping markets, livelihoods, and alliances in real time. In the contest for influence, control over infrastructure matters more than ideology. The next move is not just political, it is structural. Where leverage meets logistics, the balance of power is decided.